You ever get that feeling? The one where you're working harder than ever, but it feels like you're just treading water. Meanwhile, it seems like the rich just keep getting richer, almost effortlessly. It makes you wonder, right? Is the whole system kind of rigged? Well, today we're going to dig into that because there's one simple, really powerful idea that might just explain everything. So, our main clue comes from an economist named Thomas Piketty. Now, he spent years, and I mean years, digging through centuries of data. And what he found was the simple but honestly pretty uncomfortable truth. It's a statement that explains so much about the world we're living in. But what does it actually mean? Well, it all boils down to this little formula: R greater than G. R stands for the return on capital. Think of it as the money you make from just owning stuff, like stocks, real estate, or any asset that grows in value. G, on the other hand, is economic growth. That's mostly the money we all make from our jobs, from our labor. So when R is bigger than G, it means that wealth from ownership is growing faster than wealth from work. And here's the kicker: this isn't about bad people being greedy. Piketty argues it's a built-in tendency of capitalism. It favors people who already have wealth, bringing back what he calls the rentier, someone who can live comfortably off their assets, not their job. But here's where it gets really interesting. Just because this RG thing is a tendency, it doesn't mean every country has to look the same. Not at all. And to see that in action, we're going to compare two very different ways of handling the same basic system: the United States versus the Nordic countries. And boy, when you put them side by side, the differences are just stark. They're both capitalist, right? But the rulebooks they play by are worlds apart. In the US, you generally have a weaker safety net, fewer protections for workers, and pretty low taxes on wealth. Now hop over to the Nordic countries, and it's a whole different story. You've got a strong universal welfare system, highly regulated labor markets, and taxes are used to seriously redistribute wealth. So the takeaway here isn't about capitalism itself, it's about how much a society chooses to put guardrails on it. And in the US, you can really see the results of those choices. Inequality isn't just a number on a chart. It's something you can see and feel. You've got millions of people working full-time, sometimes more, and still struggling to make ends meet. And when that happens, trust in the whole system starts to wear thin, because you could be just one bad break, one medical bill, away from everything falling apart. Now contrast that with the Nordic model. It's a completely different reality. The welfare state creates what you could call a solid floor beneath everyone's feet. Things like universal health care and education protect a basic level of dignity. Look, inequality still exists. It's not a utopia, but it's managed. And the profound difference is that most people aren't living with that constant nagging fear that one crisis could ruin them. Okay, so it sounds like the Nordic countries have solved it, right? Case closed. Well, it's a little more complicated than that. Because even in these societies that seem much more equal, that R greater than G formula is still there, working quietly in the background, almost hiding in plain sight. And this brings us to a really important question. If that underlying force is still there, have the Nordic countries really solved the inequality problem for good? Or have they just gotten better at papering over the cracks? Housing is the perfect example of this quiet drift. Here's how it works. Somebody buys or inherits a home. Then, over the years, the property value just goes up. Their wealth grows passively, without them doing much of anything. Meanwhile, people who rent are paying that owner every single month, helping to build the owner's wealth, but not their own. You let that play out over a generation or two, and suddenly you have this huge wealth gap between families who own property and families who don't. See, the system doesn't have to be loud, it just drifts. So this makes us step back and rethink the whole problem. Maybe the real issue isn't that some people have more wealth than others. Maybe the issue is the tipping point, the moment when inequality becomes so extreme that it actually becomes dangerous for society. Let's be super clear about this. The thing that really destabilizes a country isn't just the fact that some people are rich. The real danger, the actual tipping point, is when work stops working. It's that moment when working a full-time job is no longer enough to have a decent, stable life. That's when things get fragile. And this isn't about envy. Societies start to crack when the fundamental promise, the social contract, feels broken, when your hard work doesn't get you stability, when the safety net you thought was there is gone, when you see massive wealth that seems totally disconnected from any actual contribution to society. That's when people feel trapped, unheard, and disrespected. And that's when a society becomes unstable. So,
After going through all of this, the theory, the comparisons, the hidden dangers, what's the one big idea we should walk away with?
It's this. Capitalism's default setting is to concentrate wealth. And that's just what it does if you leave it alone. But whether that leads to a functioning society or a destructive one, well, that's not fate. That's a political outcome. It comes down to a series of choices a country makes about taxes, about welfare, about how it values work. The US and the Nordic countries just show us two very different sets of choices. And that really leaves us all with one final, unavoidable question. If inequality is a choice, not some law of nature, then we have to look around at our own societies and ask, what choices are we making right now? And maybe more importantly, what kind of future are those choices building for all of us?